The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
Welcome to the Option Block. Who is this talking? This is not Mark Longo. You may have thought so, but maybe Mark Longo had become a contratti tenor. But the answer is no, this is not. This is your old pal, the greasy meatball, Mark Sebastian. I am going to be guest hosting today. Mark is indisposed. My understanding is he had a stamp collectors convention that he had to get to, and I am not the type of guy to stop him from going to his stamp collector conventions. So with that, with me is my good friend Mike Cavanaugh from Know Your Options. How's it going, Mike?
Good. Hello, everybody. I'm just anxiously waiting to see how the show goes with our new host, Mark Sebastian, today, our interim host.
Yeah, I mean, well, I can't imagine this will go any worse than a 20-car pileup. And and with me is also a special guest. I don't know what I did right, but we scored the big fish from Options Express, the king mackerel himself, Joe Cusick. Joe Cusick from Options Express. Welcome, Joe.
Thank you, Mark. I guess I've been called worse.
Well, no, I mean, it's really nice to have you here. Now, for those of you that are unaware, why don't you give everybody just a real brief background on yourself?
Sure. Former market maker, came from the SIBO, was the final place, my resting place. Came aboard about 10 years ago with Options Express and have been here multiple roles. My current role right now with Options Express by Charles Schwab is I head up all the education initiatives and do a lot of these public style events that I'm doing right now with you guys from the Options Insider. So excited to be here and looking forward to a fun show.
Yeah, me too. I think this is going to be great. Cavanaugh, and anything special over the weekend, or what did you do? Anything fun?
You actually went out to Pirates Cove in Elk Grove Village. It was a good time.
Pirates Cove.
Yeah,
that sounds great.
Yeah,
that's great. I've actually been banned from all children's establishments, unfortunately. So I'd love to go, but it just they won't let me in for some odd reason.
I've seen the signs.
But Joe, anything fun over the weekend, or you just so amped up for this week? So
yeah, you know what? No, I was very busy this weekend. I got 4 out of my 5 kids play hockey, so we kicked that off this weekend. Yeah. I mean, I'm signed up for 330 practices for the rest of the year, 150 games, and yeah. So boys, I'm always amped up to come up to the office.
Yeah. So yeah, that is incredible. That's just powerful. Now, is that the true? What's the difference between a hockey dad and a pit bull? lipstick?
I would say yes. No, believe me, when you have as many of them in this sport as I do, you don't have neither the energy nor do you get the lunacy of going after other parents or yelling and screaming, because the bottom line is after I drop one off, I got to go get another one and drop another one off somewhere. And usually it's within a state radius, which is kind of nice. We're keeping our sanity. We don't have time to be crazy hockey parents.
Yeah, well, and let's lead out of the banter block and head right into the trading block.
The trading block.
And welcome to the trading block. This is where we're going to talk about what happened today. And, despite being basically down all day and things were looking really rough. For a second there, it looked like things were really going to kind of fall off the bed there for a second. But the SPX actually ended up on the day, up about 8 to 1162. NASDAQ up 28 to 2191. Russell up 5.8 to just under 680. And the good old VIX cash ended 38.59, up just 0.07%. And, Joe, what did you think about what happened today in the markets?
Not surprised. As a matter of fact, I think after all the negativity that we've been seeing Friday going into the weekend, the Germans out there are basically kind of throwing up a little bit of a signal that they were going to go out there and, try to cover themselves for default. Not them specifically, but Europe, Spain, Portugal, Italy, Ireland, and so forth. I mean, the bottom line is that there was just so much negativity in the market that today's action did not surprise me. As a matter of fact, I was looking for the upside to come in a little bit sooner this morning, but it hit this afternoon. I think when you look at the action that was going on in gold, if you look at the action that was going on in the bonds, it was a clear signal that they were getting out of those risk-off trades. Yeah, you see it come off that 1900 level. It's pulling back. You see the GLD. It's been pulling back. A lot of cash in the markets right now, and it's not going to any other risk-off areas. So there's a lot of, building of cash reserves right now in the event that the Fed or any other government starts to pull out these either bullets or tools or whatever the heck you want to call it these days. But it looks like people are getting ready for that. Haven't jumped in the market yet, but the equities firmed up and look good at the end of the day.
Interesting. Cavanaugh, what did you think about today?
I always tell people when the VIX, is in the 30 or 40 range, volatility doesn't mean down. And I always kind of use the old standby that if you look at the VIX and it's at 40, it means the S&P could go up 40 or down 40 in the next 40 minutes. So you basically had that volatility today. I think Joe's spot on. We've been in a risk-on, risk-off environment here for the past year and a half. And when you talk about the large numbers that is sitting in cash, that has gone into risk-off mode, when they put risk on, it's going to fly. It's going to fly to the upside just as strong as it goes to the downside, and I think that's what you saw today.
Yeah, no, I actually couldn't agree more. One of the interesting phenomenon I was watching over the last couple days was the movement of VXO, and I talked about this on VolViews last Friday. Was the movement of VXO relative to VIX? Now, VXO is the original calculation for the VIX, and differentiates from VIX in that it's actually only about 8 strikes, and it is much more heavily at the money weighted than the current VIX. And what I kind of noticed was that there was heavy movement in VXO relative to the new VIX, which means to me that there was a lot more at the money buying relative to kind of up the curve, which tells you that a lot of people were looking to buy gamma as opposed to insurance. And so when they're looking at gamma, what does that mean? Realized volatility, not crazy implied volatility. So, Mike, like you said, we could go up, we could go down. They were actually interested in the price sensitivity more than they were really interested in the kind of implied volatility. When you're really worried about kind of that insurance value, you're out down buying puts. And I think that's kind of a key thing that I really noticed was today they went in and just sold right back off, and VXO went from +3 to positive 0.3% over VIX cash. The other interesting thing, and I think this is more kind of a direct indicator of kind of where risk is coming from, is that VIX has been trading above VXN, which is the NASDAQ volatility index. Why? Well, shows you where the risk is. The risk is in the financials, not in the tech. And so, it's just been really kind of interesting watching this market. It really looked like for a second that around noon that this could get to be a really, really ugly day.
But the SPOOs though, Mark, the SPOOs held up well above that 1125 mark, and I know everyone's looking for 1050 real fast, but I think to Mike's point, and I think what you're pulling out too is that the clear risk right now is to the upside, and it's because there's so much cash there. As a matter of fact, I saw in the VIX puts, the 35 puts traded, and I'm looking at these things, and they were in the Septembers, and it was, because those expire next week. I thought that the 35 puts were trading quite a bit. Again, that's an indication that, and you had duly pointed out, people aren't looking for protection. They're trying to get in front of what could be a potentially violent move to the upside, and we may be looking to be challenging 1250 before we get to that 1050 mark.
That would be really interesting. What did you hear over at OX about one of the reasons supposedly that a bunch of cash came in at the end of the day is there's a rumor floating around that China stepped in and bought a chunk of Italian bonds. Any thought about that? And what kind of what were your thoughts on that rumor? And was that something that you heard circulated over at OX?
I haven't heard anything revolved around that rumor, but I take all of that with a grain of salt, and especially when you talk about the Chinese going out and buying debt, specifically pertaining to European debt. Again, I look at that and I go, you can take that 6 ways to Sunday. Who knows if it's true? I'm looking at this more from the perspective of, when you look out at this landscape, Europe's in trouble either way. I don't know. I mean, it could be a momentary headline that all of a sudden tomorrow they come out and they go, well, they actually didn't do the debt in a traditional structure. So I take it with a grain of salt.
You got to kind of look at the source too. I'm looking at the wire here. It came across Reuters at 2:05, and it says Italy is seeking to sell significant amounts of bonds. So it looks like Italy approached them, and China doesn't just walk around looking to buy debt from countries. So who knows? I think Joe's right. I mean, you look at everything with a grain of salt when it comes across the wire. Who knows? Who knows if China's going to buy Italy debt?
Exactly. Who does know? But that was allegedly kind of one of the things that drives. But yeah, you're right. There's a ton of, and this is actually one of the reasons why I'm really, I know there are a lot of people that are long-term like gold, and I do too. But in the short term, what Joe was kind of just describing, I think that's got to be kind of a scary proposition if you own a bunch of gold. Wait a minute. So all of this paper sitting on the side is owning GLD or gold bullion or gold futures, and the moment they feel like it's safe to hop in, they're going to unwind treasuries, they're going to unwind gold, and they're going to come in and buy equities. Owning treasuries and owning gold, to me, is almost more risky than owning equities right here in a lot of ways. What are your guys' thoughts on that?
No doubt about it. I mean, from a yield perspective, I mean, that trade is already in play. I mean, treasuries right now are, I mean, full disclosure, I'm bearish on treasuries probably too long, and I'm starting to feel like Bill Gross, but I'm not ready to concede yet. But the point being is that I think you're right. I think that they're looking at where is the yield, and equities are showing it. And gold has had an enormous run. So you see some unwind here, and again, we're going to see what the instruments that various governments and other institutions are going to start throwing out there to get this, the economies and the markets reinvigorated, and people are sensing that this is going to happen very soon. We'll see.
Yeah, I mean, how high can bonds go? I was actually having this discussion the other day. I think the 30-year is trading around 141 with the I think the 30-year yield right now is around 3%. The 6-month T-bill is trading for what, 16 bips? The 10-year is trading for under 200 basis points. Let's say we stay in this zombie economy here with the interest rates as low as they are. Can the 30-year yield go to 151? Can it go to 160? I mean, what point do we start getting paid to take out debt? Where the U.S. Treasury physically pays you to take out cash.
I know. We're almost there. I mean, selling treasuries is,
put it in real world terms.
It's
who the hell? Well, who's going to give you a 30-year loan at 3.25%, which is where it's at right now? Alex Jacobson and I were talking about that today, and Jim Razan. Who's going to give it to you? Who wants to write that paper? Because the banks aren't going to give it to you. And
right.
The Chinese might be getting it from from us, but we're not getting it. So the point being is it's probably not going to be able to sustain for much longer.
No, it's insane. If I was the U.S. government, you know what I would do is I'd pre-borrow the next 30 years of cash and just sit on my borrowing and then go back and sell it to people. It's that.
I think they got 14.
I know you can't really do that.
Examples if they've already done that, Mark.
I know. it's insane. Hey, I'd go out and borrow another 14 trillion just and sit on it. You're actually going to make money on your investment. It's that crazy. But yeah, it's interesting. So with that, let's roll right into the interview block.
The interview block.
And welcome to the interview block. This is the section of the option block where we pull in somebody that is really, really smart, and we try and get him to talk to mine and Mike Cavanaugh's level for a little bit. And of course, when you get a guy like Joe Cusick to come on your podcast, you take the opportunity to interview him, and we're going to do that. So Joe, let's just quickly talk. So, you're the head of education. Talk to our people about some of the kind of the progression that you think most people should go through when learning about options. If you had an investor walk up to you and they said, "I know nothing about options," how would you lead them down the path of eventually becoming Joe Cusick?
Well, the biggest thing is that tell clients this day in and day out. Define what your objectives are. Define what your risk tolerances are. And then once you've defined those areas, then get into the discussion of what are the vehicles that you're going to start to utilize to meet those objectives and fit within your risk tolerances. The reason why we do that is it allows people to then grow into the versatility of a derivative product. Because remember, derivative products are enormous. It's not just calls and puts, it's futures and a plethora of other different products that are out there that are, traded in open markets and cleared and, through so that you don't have these counterparty risks with some of the other derivative products that have gotten us into this mess that we've been getting out of for the last 2-3 years. And so when you have a meaningful discussion about objectives, risk tolerances, and then, how the vehicles that I embrace, which is options, it just blows their mind away, because then we get into discussions, and I know Mike has these discussions. Mark, you've had these discussions with people before. Then we talk about high probability, low risk opportunities, and when you get especially into a market environment like this education that we throw out to them just blows them away, and they just can't believe that this has always been out there.
Yeah, and Joe, a lot of times, would you say a lot of times that you get pushback from people when they're first learning about options, that options carry the perception that they're too risky? Do you get that pushback, and how do you address that if somebody says, "Oh, options, isn't that how Uncle Jimmy lost $40,000?" How do you address that?
I guess the biggest thing is it's just like getting into a car and driving is dangerous too. But if you understand, first of all, what the mechanisms that are in front of you as far as the gas and the brake, the rules of the road, you start to build in some confidence about driving. It's the same thing with self-directed investing and incorporating different products. The bottom line is that 2 years ago, if someone would come up to you and say, you know what, I have these 2x, 3x products that trade like an underlying, and you could trade 2 times, 3 times, 10 times bearish. Would you do it? Well, maybe, but the point is that they were doing it blindly without educating with the client about what these products are. If they take the time, and Mike, this is the bigger problem. When they say that this is just gambling, they're just throwing money away. I said that, well, you know what? That's because you're not taking the time to just understand the cornerstones of this. You know, what are the risk factors? What are the reward factors? Because buying options is just what you pay for it is what you risk. And then they start getting greedy, thinking that they can buy these cheap instruments and gamble. And then we got to work them through that process of decoupling that concept of cheap lottery tickets. And so that's how I work people through this: is just sit down and focus on these principles first, and then we get them all excited about it, and then we move into higher probability situations where they can take volatility and mitigate that, where they can go in and collar off a position, which I know you and Mike profess profusely. And Mark, you love to go out and speculate. You love to look at markets and you look for opportunities, and you want to put those high probabilities in your wheelhouse, and you might bang out a couple naked strangles or straddles. I mean, this is how we trade. And then once people get those cornerstones, those statements that I just made and those examples that I just threw out as far as what people look at when they get into certain environments, they get excited. They see opportunity.
How do you taper between at OX, you've got this kind of it's a good thing. You get these excited investors that are really ready to move into trading, which you obviously want. But at the same time, what I was asking was, how do you balance keeping investors really excited while teaching them the stuff that's maybe not as fun? It's not that options are a great vehicle, but I tell somebody to read Macmillan or a Natenberg book, and they look at me like I, slash their tires sometimes. How do you get excited while really forcing that learn what you're doing attitude that they have at OX?
Simply down to this: making it realistic. That's what it's all about. And if people are going to come in and think that they're going to make up what they lost over the last year or 3 years using a nominal amount of money, I'm going to be a realist. And so the bottom line is that we take a realistic approach on how to teach people how to use derivatives and incorporate it with the other objectives that they might have. The bottom line is people will sometimes lose that focus. And, again, that's why we're here, to get them refocused and continue that long-term engagement factor. But to say that we can make, 20, 35% returns with some very consistent approaches, that could be a feasible discussion to have, but it's going to take a lot of discipline. And you know what? We're going to have to break away from just throwing a book like a Natenberg or a Macmillan book in front of them saying, read this and then come back and talk to me.
What would you say are some, we've talked about a lot of the common mistakes that newer investors make. What about kind of some of the more advanced traders you get? OX has a pretty large institutional base. It has a pretty large advanced trader base. What are some traps that you find them getting into, and what's some educating that you have to do for maybe the more refined trader and some of the more advanced traders?
I think the biggest thing is that those traders, whether they're high net worth or they're more, as you call them, refined, more sophisticated. When you get in environments like we're in today, what you'll find is that sometimes they size too big, or they don't look at the ability to take a step back and maybe look at alternative strategic approaches that may seem riskier on the surface, but actually are more risk averse than what they were currently doing. A great example right now would be someone that's going in there and they're keeping their size with vol at 40 and after it popping. I've been professing to people, take a step back, size down, tighten up the widths of some of your spreads so that you're getting a greater probability of success rather than increasing your size because vol popped. Things like that, just general trader concepts that, we as on the floor, when we were on the floor, we would take a step back and pull in the reins because there was just that factor of uncertainty that just doesn't make any sense, and where you're still, you don't lever up your balance sheet too much, so that if all of a sudden things do go haywire, you're sitting there holding a real bad bag. And so that's the biggest thing that we tell that segment, that I like to call it, pull it back a little bit, pull in those reins.
Yeah, it's so tempting to get out there and get into size. One last question for me, and then I'll, Mike, you have anything, please toss in there.
Yeah, I know I'm extremely talkative.
Yeah, no, I mean, well, you're great. But what are your thoughts of all these volatility products, all these kind of VIX-based products in either ETF, ETN, or the options themselves? What have your thoughts been on all these volatility-based products that have been coming into the marketplace? Do you agree with us, with the SIBO, that the volatility should almost be an asset class now? And Cavanaugh, actually, I'd love your thoughts on that as well after Joe tosses out there.
Yeah, I believe that volatility has become an asset class in itself. I think you have to be careful with how you trade some of these products. I remember when they first came out with the VIX options, and back in 2008, 2009, we were just telling people, don't trade it because you don't understand what it is. You don't understand what the underlying, how this thing is priced. And, people were doing calendar spreads and just getting their accounts blown out because of the risk. They didn't understand what they were getting into. Now, you could take an approach where you say, well, there's enough education out there, but, with the various products that you have out there, it's a little bit easier for with the VXX, the VXN, things of that nature, where you can put on something like a bear put spread, or a bull call spread, or a credit strategy of any nature along those lines, and you could trade vol that way from a universal perspective, right? I think it's a great idea that people are utilizing the products for hedging their overall portfolio from volatility risk and mitigating it when they're not spreading it off with options on the individual components. But, Mark, I think it's a young group is going to mature, and the retail is trading it more and more. But I think we have to be very focused on the strategic approaches that we take with it, because otherwise you can get really hurt really fast if you don't understand the risks and rewards and how how these things react in certain market environments.
Great, Cavanaugh. Any thoughts? Anything you want to add to that, or?
Yeah, sure. I mean, I'm an apples to apples guy. So, I mean, I do agree with Joe that volatility has become an asset class, but I think it's become an asset class because it's the new thing. We always need the new thing in the marketplace to kind of keep us interested. And when you have a stock portfolio and you incorporate 2 to 5% of that portfolio to be long volatility in some capacity, I'd rather be long volatility in the form of the put on the underlying that I physically own than trying to hedge the entire portfolio as an asset class and including that portfolio in there, or that volatility, whatever asset it is, whether it's the VIX, the VXO, the VXX, the VIX futures, any individual volatility instrument. I think it's important, whoever the end user is, whether it's a hedge fund, a registered investment advisor, a retail client, an institutional client, I think they have to know within a certain amount of reason what the portfolio is going to be with that position in it. And you really don't have that long of a track record to say, well, when the market does X, your portfolio should be at X with this volatility asset in the portfolio. We've got a bunch of hypothetical back testing that can, put a value at risk model in place. But I don't like values at risk. I like dealing with absolutes, and the best way to deal with absolutes is with the vanilla options on the same underlying.
Well, great. And with that, we will end the interview block and roll right into the strategy block.
The strategy block.
And welcome to the strategy block. And this is where all the pledges sit around Pledge Master Mike Cavanaugh's stool as he tells us wise stories about trading and many of the wonderful things in the world of investing and trading.
Yeah. So, I mean, today for my session, the strategy block, Professor Cavanaugh here, I want to take a look at what I've seen in the marketplace and then how to intuitively build a long-term investment portfolio for the trends that I see in the market. So we were talking earlier in the show about risk on, risk off. There's a lot of money in cash, and the money sitting in the sidelines is not looking at the typical risk off maneuver has been buying U.S. treasuries or some form of U.S. Treasury debt, money market debt, whatever it is, a cash equivalent. Now it doesn't feel like you're getting paid for the risk and your risk off capacities. So where I see some money shifting and we're fielding a lot of questions is more to the blue chip dividend paying stocks, the Dow 30, the big boys, the P&Gs of the world, the Disneys, the J&Js, the Colgate Palmolives. So with a lot of interest shifting back from the old value growth stocks into the blue chip dividend paying stocks, what we've been trying to help people with is focusing on picking a good stock and getting that into your portfolio. Once you have 8 or 10 stocks that you feel are blue chip high dividend paying or reasonable dividend paying stocks, how do you go about hedging that? And I know I just said I like buying apples to apples, but at some point buying individual puts becomes very, very expensive. So what we do is we try to, after we have the 8 to 10 stocks in the portfolio that we're comfortable with holding for a long period of time, is we look to add some income to the portfolio by selling call options on the 8 individual stocks that you end up purchasing, using the premium that you collect from selling the calls on the 8 individual stocks to purchase put spreads, bear put spreads on the SPX, so the S&P 500. So the key to this statistic is making sure you know what the weighted beta of your portfolio is. And for all of our listeners, that if that's a new term, beta is basically the correlation of your portfolio for any percent move of the S&P. So if you have a beta of 1 and the S&P goes up 1% or down 1%, your portfolio should go up or down 1%. So once you've determined what your weighted beta is and you've got the 8 to 10 stocks in your portfolio, you can decide, you're going to sell calls monthly, quarterly, biannually, annually. You can sell leaps, whatever you determine that you're going to pay for the puts and the time period that you're going to short the calls. You take good portion, whether it's 50%, 75%, or 100% of the call premium taken in. You go out and you purchase some put spreads. Joe mentioned it earlier about weighing sentiments. If you're bullish, then you shouldn't do this strategy whatsoever. The strategy would be more for the person that's looking to take some of the volatility out of the portfolio. You can only lose X feeling because it's not an elimination of risk, it's a transfer of risk. So you're trading part of your upside to hedge part of the downside. The put side that we've been buying, once we get a good correlation of what our beta is, we'll go out and buy bear put spreads on the S&P 500, the SPX, the cash index. So maybe with the market here at 1162, you think that the market may be down 5%. You go out, you buy the March 2012 1100 puts. You go 100 points down and you sell the 1000 puts. Today, I think that was trading around $30. It would cost you $3,000 per one contract. The notional value of that contract is 100 shares times the underlying index. So call it $116,000 per one contract is what the notional value hedge is. But that gets knocked out once it gets to 1,000. So you'd be long the 1,100 put, short the 1,000. So you're protected down to 1,000. Your protection kicks out at 1,000. So you have to manage those risks. But you pay $3,000 for the spread. You got a profit potential of 7,000. Your max profit at 1,000 whenever the expiration is. If you bought them in March, so the third Friday in March, if the index is at 1,000, you're going to make the max profit on the bear put spread. You're going to lose money on the portfolio. So the real trade becomes, can you finance the purchase of the puts, pick a good time to sell the puts, and catch a rebound while you're collecting the premiums on the calls and the dividends. So it's a hybrid. It's more complicated than just a straight collar. It's a mouthful. So if anybody has any questions, I'm more than happy to go over it. But that's kind of what we've been looking at. And we're getting that based on what people are coming to it with. They're coming at us with, hey, I want blue chip, high dividend paying stocks. I don't want to just buy the stock. What's a way that I can hedge some of this? And that's what we're cooking over here.
That was great. And with that, we will roll out of the strategy block and into around the block.
Around the block.
And welcome to Around the Block. This is the section of the show where myself and Mike and Joe are going to do our best to prognosticate about what's coming on between now, what's going to happen in the marketplace between now and the next show, or at least talk about important things coming up. And Mike, you watching anything for the week ahead?
Yeah, Dr. George pulled one out of the bullpen today here. Dollar General. He likes it. They just beat their earnings a little over a week ago. They did a 25 million share secondary offering about 3 days after their earnings, and the market basically swallowed that up pretty good. A lot of times secondaries dilute a stock, they knock the price down. Well, this thing absorbed the secondary offering and bipped up a couple days afterwards. They're planning on opening another 600 stores in the U.S., and they're going to start launching an e-commerce site. Stocks right now, it's at about 35.5. Dr. George likes it, which means Mikey likes it too.
That's great. Joe, you watch anything for the week ahead?
Yeah, I'm keeping my eye on FedEx, eBay, Citrix. I'm still watching the VXX a little bit. Barrick Gold is another name that you can keep an eye on. Mike was discussing this in the strategy block. Me by training and from what I came from, I'm an options seller. So a lot of this positioning that I put in there is usually some sort of verticals. I don't like to buy stocks. I think that, when you're looking at, $50, $70, $100 stocks, it gets a little hard for most people that listen to the show to think about, doing cover calls or things of that nature on there. And in this environment, it's hard to put up, 7,800 or 10 grand or 15 grand into one stock position. So I like to look at some verticals, and I'm looking at probably taking advantage of some of this vol, looking for a high probability of profitability, in some of those names, looking at some verticals and over the course of this week.
Yeah, you bring up a good point. I've been watching, during one of the nice things about a market like this is that low vol stocks look at high vol, and those can be some great opportunities to go in and sell premium. As far as economics go, I'm looking at two things that I think are going to matter. Retail sales on the 14th, and then Philly Fed comes out on the 15th. I think both of those could really have a major impact on the market. But really, I think until Greece gets resolved, we're just going to be kind of range bound. And I'm expecting that to get resolved within the next 10 days. Just one way or the other. I think we're going to know in the next 10 days what the story is, because it looks like things are basically coming to a head. They're either going to fix it or they're not. And so I'm going to be keeping an eye out for that. In terms of stocks, all those you mentioned, Best Buy has earnings tomorrow. I think that will be an interesting one. I'm kind of interested in what their big purchases were. Aside from that, I'm not going to feel comfortable about where the market is until I see VIX cash fall below the VIX futures, and until we enter a contango and get out of this backwardation. Until we're out of this environment where near-term fear exceeds long-term fear, I'm just not going to be willing to say, hey, everything's A-okay. So,
Mark, you're not going to see that. You're not going to see that until the labor market firms up. So if you're watching the retail sales this week, watch that number, because that's going to give us a better indication of going into the claims data that you're going to see, which I think is definitely something to keep your eye on. And then the end of the week with that Michigan sentiment mark, that's where you're going to get a pulse right now.
Yeah, no, I agree. And with that, let's close around the block and let's talk about what's going on at our different things. Joe, any events coming up at Options Express?
Yeah, we actually have a really big event going on in Denver this weekend that we're really excited about. We're going to be out there. We already have close to a couple hundred people that are set up to attend.
Wow.
So definitely keep that on your radar screen. Also, October 1st, we are doing our first ever a joint event with Charles Schwab. It's going to be at a Schwab Trading Forum. It's going to be in the D.C., Virginia area. We're going to be posting information on that on the website. But we're extremely excited about being in the family. We are legal now. And so that will be our first event on October 1st. And it's going to be a great day. So we look forward to being there.
Mike, what's going on at KYO, Know Your Options?
Not quite as exciting. That's exciting stuff to have that first live event in October for OX and Schwab. I wish I could go. We've got a couple things coming up. We've got Mike Tusaw was featured this month in Futures Magazine with one of his strategies, the old 1x2 stock repair ratio spread. I wrote an article that was featured in the Journal of Financial Planning talking about how to hedge equity risk using options. So just a couple of nice little write-ups. It's good to be in the press. Outside of that, we don't have any major events planned here in the upcoming months, but we're always talking to people.
All right. Sounds good. That's great. And at Option Pit, I have tomorrow marks the first of I'm doing a 5-part series that's a follow-up to the How to Trade the VIX course I taught at the SIBO on Saturday. It's a 5-part series on trading ETFs, ETNs, VIX options, volatility futures, so VIX futures and the new Volux contracts over on the CME. Basically, anything that's volatility, this 5-part series is going to cover all that. And we're looking forward to really diving into that. It's going to be a lot of fun. And then on October 21st, myself and Jeff Quinto are going to be doing an all-day live event in Chicago at the Old Mercantile Exchange on using volatility to improve futures and futures options trading. It should be really, really exciting, and we're really looking forward to it. You can sign up for both at optionpit.com/events. And with that, I would like to thank Mike Cavanaugh for coming with us. And Joe, it was an absolute pleasure having you on. And
thanks, man.
Please come back.
Sure. You bet. I'm excited. This is great. Thank you.
All right. Have a good one. And with that, I am Mark Sebastian. Mark Longo will be back on Thursday. We'll see you all then.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.